Hi, welcome back to my channel once again. So in this video, we'll be looking at how to analyze investment appraisal. So we have here project 1 and then project 2. So each of them require the same capital investment, and these are the various inflows at the end of each year and then the outflows. Same as the project 2 as well. These are the various inflow and then the outflows. Now, these two projects, because of capital constraint, this project you can only undertake one at a time. That is, they are mutually exclusive. So, in order to assess which of the project will be viable, they have to look at some various KPIs. So, we consider the net present value, which you are finding the sum of all the net present value. Then you compare whether it is giving you a positive returns or negative returns. As we all know, the general rule is that when the NPV is greater than zero, you accept the project. When it is less than zero, you reject the project. They also have another KPI, that is the internal rate of return (IR). So this measures how which rate will make the NPV zero. In other words, what should be the expected increase in the cost of capital in order to make NPV to be zero. So the IRR is what? It should, before you can accept the project based on IRR, then IRR should be greater than the discount rate or the cost of capital. Then the next KPI will be the payback period. So this is where you are much concerned about the cash flow of the business. So you want to quickly regroup all your investment quickly. So here you look at in which year will you be able to generate net cash inflow. So here you will find the various cumulative cash flow that we consider which of the year that will give us positive net cash flow. Okay, so we'll also be doing the same thing for the project 2 as well. Then at the end, we'll now compare all the three KPIs. Then we choose or advise which of the project is viable. Okay, so now let's assume that the cost of discount rate is what? 12% for each project, and then the initial investment is the same amount for each project. So now let's find the net present value for the project one, which should be the the cash inflow plus or minus the negative inflow. So let's hit enter here. Then now let's now drag it to the last column. And now let's find the NPV. So the NPV is equal to, you start typing NPV here. Then the first argument is rate. So this is our discount rate here, comma. Then it's asking for the value 1. So please remember that this initial investment is already in year 0. So we can't discount it again, but rather let's discount from year 1. So we're going to highlight all this so the system will discount it, and at the same time sum them as well. Then we will now close the bracket, plus we will now add this already discounted amount in year 0. Let's hit enter. It give us this amount here. Then let's also find the IRR, which is equal to, we start typing IRR, it will pop up. You select this. Then here you select all the net cash inflow, the net cash inflow outflow at the end of the year, starting from year 0 to the end of the project. So year 0, these are the net cash flow. You highlight all this, enter to give you 18%. Then again, let's also find the payback period. So here you have to find the cumulative cash flow at the end of each year. So the year 0, it will be the same as the initial investment. Then this initial investment here will be added to the what? It will use to reduce this net inflow. So it will go in that order. Let's drag it to the last end here. Good. So now let's find the payback, which should be the year in which the investment is started generate what? Net positive cumulative cash flow, which should be year 3. But because there are some portion of year 2 that they will have used, then you have to what? Consider year 2 as part. So we click on year 2 there, plus then we pick the absolute of the ratio of the closing cumulative cash balance divided by the year in which there is what? A cumulative cash balance, which this is the net cash generated for that year. Let's close bracket here and hit enter. So you can see that then the cash flow is what we can, the cash flow is what? 3 years. So we can also adjust here to maybe 2 decimal place, which is what? 2.9 years. So as you can see here, it's not entirely exactly 3 years because there is some portion of the what? Of the cash inflow that were utilized in year 2 as well. Okay, let's also do the same thing for project 2. So here we are summing all this as well. This inflow plus the outflow there. Let's highlight all this. Now let's also find the NPV here as well. So NPV is what? The rate here, comma, then highlight all the cash net inflow starting from year 1. So we exclude the net inflow for year 0 because already it has been discounted. So all inflows or outflow in year 0 is always what? At year 0. So there's no need to discount them again. Then you close the bracket plus, then you add this already net inflow in year 0, enter. So as you can see here, this is the NPV here. Then let's also find the IR as well. So also start typing IR here. So here you highlight all the value, the net cash flow or inflow at the end of the years, starting from year 0 to the end of the project. Here, enter. So you can see that it's all 19%. Then again, let's also find the cumulative cash. Year 0 it will be the same as the net balance for year 0. Then you now pick the previous plus the current net cash balance, and then we'll drag it to the last column here. Then we can see that this cash started, we are experiencing a cumulative cash balance, positive cash balance at the end of year 4. So you are going to include year 3. They will find a ratio of the closing balance for year 3 and then the total net cash generated for year 4. So let's do that. So it's equal to, we pick here year 3 plus absolute of the ratio of the cash balance for year 3 compared to the total net cash generated at the end of year 4. Let's hit that. So you can see here, it means that what? The project, the cash, the cumulative cash balance was not entirely year 4, but rather a some portion of year 3. The full year 3 plus some portion of year 4, that give us all three quarter years. So now let's consider this. Now when you look at the same rate for each of them, and then the project NPV here is 35,000 plus 59,000 plus. So you can see that looking at NPV, this project what maximizes the shareholder return more than project 1. Then again, when you consider project 1, 1 IR is 18, where IR is what? 19 for project 2. So in other words, when you compare these two IR against the discount rate, it means that before this, for example, for project 1, when the interest rate increases by what? 6%, which will mean 18, then here the NPV will now be negative. This means that this project will not be accepted. And again, when this one also increases to 18, still we have what? NPV is still positive because now we still have what? 1% extra return for the shareholders. So it is always advisable that IR is what? Superior to NPV. So now before the NPV can be 0 or less than 0, then the discount rate should have been what? More than or equal to the IRR. So in a situation where you have both NPV and IRR and then the IRR is more than the cost of capital, then it's advisable that you select what the the greater IRR. Okay, then when you look at the NPA, the payback period too, although it may take what about almost 4 years for project two to recoup its investment, whilst it will take about what, 3 years to recoup investment. But in all, are we maximizing the shareholder return? Project two, although it may take some while to maximize returns, to recoup returns,